Welcome. Today, we're doing a deep dive into the market operations of Central Huijin from the first half of 2025. What the data shows us is not a simple state-led rescue. Instead, what we're seeing is the emergence of a highly sophisticated, multi-layered strategy that is actively reshaping China's capital markets.
So let's get straight to the core thesis. Huijin is now operating as a coordinated three-tiered system. Think of it like this. There's a strategic anchor, providing a permanent foundation, a tactical stabilizer for dynamic, broad-based intervention, and a policy sniper making precise, surgically targeted investments. Understanding these three distinct roles, that's the key to decoding this new playbook.
So, how exactly is this system executed? Well, it's not one single entity doing everything. It's a very clear division of labor across specialized players. Let's really dig in and unmask these players to differentiate their strategic goals from their tactical actions on the ground.
Now, a critical piece of this puzzle is the structural separation of roles. On one hand, you've got the parent company, Central Huijin Investment. Its job is to be the strategic anchor, long-term, passive, structural. Then on the other hand, its subsidiary, Central Huijin Asset Management, acts as the tactical stabilizer. Its role is dynamic, responsive, and designed for active, large-scale market intervention. This separation is absolutely crucial because it allows for both permanent stability and short-term flexibility, all without sending mixed signals to the market.
And the data provides crystal clear evidence of this anchor role. Just look at the portfolio of the parent company, Central Huijin Investment. It was almost completely static in the first half of the year. Of the 21 ETFs it holds, the share count for 20 of them remained entirely unchanged. That's the textbook definition of a passive, long-term foundation.
But in sharp contrast, while the parent company was standing still, its asset management arm was incredibly active. This entity increased its ETF holdings by a staggering 659 billion shares in just the first half of the year. This massive purchasing activity really confirms its designated role as the market's primary tactical stabilizer.
The sheer scale of this intervention is one thing, but you could argue that its breadth is even more significant. Because this strategy extended far beyond just propping up the usual large-cap blue-chip names.
And the capital firepower here is truly significant. Our analysis estimates that over 210 billion RMB was deployed by Central Huijin's asset management arm in the first half of 2025 alone. That figure really underscores the immense financial commitment behind the stabilization mandate.
Now, where that capital was allocated, that reveals a full-spectrum approach. Of course, significant funds flowed into the traditional large-cap indices, but a substantial portion was also directed into mid- and small-cap indices, like the CSI 500 and 1000, and even into tech-focused benchmarks like the Star 50. This is a really critical evolution in their strategy.
So what this really signals is a major move away from targeted rescues of specific stocks and a move towards broad-based liquidity provision for the entire ecosystem. The objective seems to have evolved. It's now about preventing systemic liquidity crises and ensuring a much more inclusive form of market stability.
Okay, so beyond that broad support, there's a third, much more precise layer to this strategy. This is the work of the policy sniper, and this involves using specialized vehicles to make highly targeted, policy-driven investments.
Which, of course, begs the question, if all that broad index buying was for stability, where did Huijin place its high-conviction bets? Where did it try to not just stabilize the market, but to actively signal policy direction?
Well, the answer seems to lie in the fund flows of its special-purpose vehicles. In the first half of 2025, we saw very clear increases in exposure to themes like semiconductor chips, high-dividend state-owned enterprises, and even Baiju. And at the exact same time, exposure to sectors like 5G, medical services, and tourism was being reduced. These are not random trades. They are very deliberate, strategic shifts.
And the logic behind these moves becomes pretty clear when you look closer. The semiconductor investment? That directly supports the national strategy for tech self-sufficiency. The focus on SOE dividends aligns perfectly with the policy push for a Chinese characteristics valuation system. And the move into Baiju? That looks like a classic counter-cyclical value play, entering a sector at a moment of deep market pessimism.
So, this all brings us to the final and maybe most critical part of our analysis. What are the real market implications of this new, highly visible and highly structured intervention model?
The primary consequence is the creation of what we call in finance a policy put. This is the market's perception that a powerful entity, in this case the national team, will step in to establish a floor,
It effectively prevents the market from falling below a certain level, and that fundamentally alters the risk assessment for every single participant.
Now, this Huijin effect is really two-sided. On the upside, sure, it reduces systemic tail risk and it dampens volatility, which could attract more stable, long-term capital. But there's a downside. It creates the potential for moral hazard, where investors take on too much risk because they think they'll be bailed out, and it can lead to asset prices becoming more dependent on policy signals than on underlying business fundamentals.
Ultimately, what we're witnessing with this Huijin model is a profound reshaping of the market's risk landscape. So the central question for every market participant right now is this: does this new, highly visible state presence represent a generational opportunity for stability? Or does it represent an entirely new and more complex form of risk? That is the debate that will likely define this market for the foreseeable future.